All right. Hi, everyone. This is Sasha Hodder, and we're here on the Hodlcast today with Peter Temko, who is an accountant and specializes in Bitcoin accounting specifically. Today is July 24th, 2018, and Peter has been generous enough to let us kind of pick his brain on how everything to do with taxes and Bitcoin. So Peter, maybe you could just give us a little background of yourself, your educational background and what you did before you got involved in crypto.
Okay, thanks a lot, Sasha, for having me on. I really appreciate it. And hopefully I can provide a lot of good information for all your listeners so if they didn't already know, they can know a little bit more about how to keep themselves prepared and ready for any kind of tax issues that come up. I originally got my bachelor's degree in accounting, got my MBA, sat for the CPA exam, got my CPA. I've been a controller and CFO at a couple of different companies. So I've worked in industry, distribution, manufacturing. And a couple of years ago, I decided that I really wanted to branch out a little bit more and get more involved with helping people with their companies, helping individuals with situations that they had that came up. So I started up my own firm and started doing business consulting and tax preparation for everybody. And it was about a year and a half ago now. It seems like longer, and at the same time doesn't seem like that long ago, that I really started getting interested in cryptocurrencies as a way to help diversify some of my retirement accounts.
Okay, so you were using it for your own accounts
And
before
so
starting any kind of accounting with them.
Yes. So even before doing any kind of accounting in the crypto area, I've been doing just standard stuff before that, and decided to do some of that for myself, and found one of the trusts that's out there, GBTC, that I was able to use in my traditional IRA accounts, and dabbled a little bit and get in some Bitcoin.
Okay, and this is a little off the tax topic, but for that GDBC, it's called?
GBTC.
GBTC. Can you buy anything other than Bitcoin in it right now, or is it only set up for Bitcoin?
Yes.
Okay.
It's a financial trust that was set up that holds Bitcoin.
Okay.
And then they have shares, they have shares that are available over the counter that you can buy those shares. So you're not really buying Bitcoin, you're buying shares in that trust that's holding Bitcoin.
Okay, and then those are tax protected through the IRA.
Well, because I have it in a retirement, I have that. I have both the traditional IRA and a Roth IRA. Yes, but even if you had a standard retail brokerage account, you could purchase it through there too. It's just then you're subject to taxes on your gains or losses that you have.
So the way you have it set up, you could buy. Say, if I were to get one, I would buy the Bitcoin now. At today's price, $8,000. And then when I was in retirement, I could start withdrawing it, and my tax basis would be the $8,000 that I buy today. But any trades in and out of Bitcoin along the way, I wouldn't have to pay tax on. Is that how those work?
If you're doing it in an IRA account, that's a retirement type of account that has that tax protection, then right, as you're buying or selling that trust fund or that trust account, you don't have to worry about the taxes at the time. You're going to be taxed. It's tax deferred in either one of those. And if it's traditional, then you're going to have to pay taxes on however much that grows to when you start doing withdrawals. If it's a Roth IRA, then you already paid your taxes with your contributions. So there's no taxes on that while you're trading, and there's no taxes on the money that you withdraw. So I always recommend for anybody that has a Roth IRA, that's an option. Take a look at that and see if hopefully they'll be coming out with some more ETFs. I know that's always been in the news. Is it going to happen? Is it going to happen? And we've got another situation that's coming up here shortly in August. Hopefully sometime in August they'll have some more guidance on whether an ETF can be set up. But anything that's set up in the retail brokerage arena is going to be something that you should be able to use within your retirement accounts as well as a retail account. And Excellent. You can have some significant tax advantages by doing some investing through those. Now, the one thing I do have to mention is the GBTC, especially because it's the only thing that's out there right now you can use for traditional investing accounts.
So you could buy stocks in it as well, right next to your Bitcoin.
Yep, stocks, bonds, whatever you would normally buy, you buy there. Because you're not actually buying Bitcoin. You're buying shares in a trust that's holding the Bitcoins.
Okay.
They did a split earlier in the year because it used to be, I'm not going to have the numbers exactly off the top of my head, but their fund used to be, a share of their fund used to be a seventh of the value of Bitcoin, but because Bitcoin went up so high in price, they ended up doing a split that was something like 97-1. So now one share, so it's very affordable to buy that GBTC now, because one share, I think one share now goes for between $10 and $12, maybe $13 right now.
Okay.
So you don't have to have enough to buy one whole Bitcoin. You can buy obviously a very small fractional share.
It's funny too that you mentioned that. I find so many people, when you talk to them about Bitcoin, they think you need to buy a whole Bitcoin to get into it, and they don't realize you can just buy $10 worth or even less.
Yes. Yep. Yeah. All the way down to one Satoshi if you can split pennies and get that far down.
So once you started investing in your own on that, how long did it take for you to go from there to offering financial or accounting services to others?
So I started late 2017 is when I started looking into and getting ready and offering services to individuals that were that needed help with their tax preparation with cryptocurrencies. And
how many people would you say? Like, I remember reading on Coinbase, it was something like around 1,100 people in the whole country filed taxes in 2015 to 2016 timeframe. Was it more than that, do you think, in 2017 that filed, and again in 2018?
Yeah, I think 2017. I think it's safe to say it was significantly more. I don't have any numbers. I know for myself personally, I had quite a few people. It wasn't as high as the 1,100.
But
I had quite a few people
using it.
One person doing it. I did a considerable number of people that came and did their taxes for their cryptocurrency holdings. I've had clients that came back, and because they've got notices from Coinbase back from those years, I had some clients that wanted to make sure to go back and amend their taxes. So we went back and did that too, make sure it's interesting too, because a lot of times with those notices, it might say you had $20,000 worth of trades, but some people, they bought the Bitcoin and then used it on a site immediately after they purchased it. So they might have had $30,000 in trades, but they had $70 worth of gains.
Oh,
on that. So even for those people, if they really wanted to just be able to sleep at night, not having to worry about getting any more notices, go ahead and do the amended return, get all that in, so that the IRS knows that even though you had all these trades, you didn't have any gains on it. And then that way you can stop that flow of paperwork that keeps coming your way. So that's one thing I recommend, is if you do have historical transactions that weren't reported, it doesn't hurt to just go back and take care of that stuff. Look through it all and get it all straightened out.
Yeah. So can you give just a general overview of how is Bitcoin taxed, and the trading, the difference of if you're just using it for store of value, whether you keep it for over a year?
Sure. So the initial purchase, and this 2014, I better to start out with the history, right? In 2014, the IRS came out with guidance on cryptocurrencies. And in that guidance, they identify cryptocurrency as being property and treat it as property very similarly to stocks or bonds or other types of retail investments like that. So with that said, what that means is when you purchase, just like if you purchase a stock, on the purchase, there's no tax consequences. You don't have to worry about paying taxes on any of that. You do want to make sure that you keep your records. So you want to make sure that you've got the date, how much you bought, and how much you bought it for. So you might, if you bought it in the end of 2016, and you bought one Bitcoin and you bought it for $700, you just got to make sure you keep that record. And so now if you were to sell, and this is one thing that there's a lot of misinformation that was out there before. If you sell or trade that Bitcoin, so if you converted it back to USD, or if you swap that Bitcoin for Dash or Monero or any other kind of coin that's out there, that's your taxable event. So if it's under a year, then that's classified as the same rate. That's classified at the same rate as your earned income. So whatever you report on your tax return for income, that those gains or losses get included in your earned income for that year. If you hold it for a year and a day, then it converts to either into a long-term
Like a
capital
gain
gain or loss. Yeah, right. So you've either got the short-term capital gain or loss that's treated just like your income that's coming in, or once you've got over that year threshold, then you've got the long-term capital gain. Those are significantly lower rates. Again, it's based on your income levels. It could be 0% if you make under 38,700 for 2018. So if you're somebody that has a blue collar job, scraping by, and you put some crypto away as your savings vehicle, then that's one benefit you have is you don't have to pay taxes if your
does that. So say you're someone that was making 35 grand,
Yep.
but you're a Bitcoin whale and you sold 100 grand worth of Bitcoin and it's a capital gain. So now you've got 135 grand for the year. Do you have to pay income tax on that as well?
Yeah.
Okay.
Yes. So if you can sell off, if somebody had $25,000 in earnings and they decide they're going to sell off $10,000 worth of their Bitcoin holdings, maybe they've got 100,000 or several hundred thousand, they're still going to be under that threshold. So that's 0% tax. But if you start to go over that threshold, then you start hitting the tax.
So they're going to pay the 20% or 10%, whatever their capital gain rate plus then whatever income the whole thing is, or just
no income. It's just,
okay. So it's no income, just capital gain at whatever rate that is.
Yes, for long term, it's going to be that capital gains rate, whether it's 10 or 20%, depending on how much that they have. Yep.
And what if they bought the Bitcoin on an exchange in another jurisdiction outside the U.S.? Do they still have to pay the taxes here in America?
The United States is one of the few countries that taxes worldwide income on their citizens. Yes. So it doesn't matter where you're making the money. They, without getting into too much of the detail on that, is you don't have to pay on top, because you don't have to pay extra taxes. So if you're in a country, if your tax rate in the United States is 25%, and this other country that you had this money in, if it's taxed at 25% in that country, you have to pay the difference, which in that situation would be zero. You wouldn't have to pay any extra taxes. But if your tax rate's 35% and their tax rate's 25%, then you get credit for the 25% you paid in the other country.
Okay.
And you have to pay the additional 10% to bring you to the U.S. IRS rate that you're supposed to be paying on it.
So say, like I'm Canadian. So say I went to Canada for the majority of the year, my taxes in Canada are higher than my tax rate here. So if I paid tax there, then I might not have to pay it here. Exactly. If it's over, but I'd have to come to someone like you and get it looked at to really know and to be able to report to the IRS.
Yes. Yeah, you've got to be able to show that those taxes were paid so that you can get the credit for that. Yeah.
And so one other thing that I always wonder about the crypto taxes, so with the stock, if I were to transfer my stock from TD Ameritrade to Swift Trade or E-Trade, or, say I had one Apple stock and I just switched it from every different exchange, my cost basis is going to stay the same as when I purchased the Apple stock initially. It just gets transferred in kind across all the exchanges. The way I understand the tax software works in our Bitcoin exchanges is that it calculates it as a buy and a sell every time you move it between an exchange, just because they can't communicate to each other to know, that's, and it would be impossible, I think, for exchanges to build that kind of sophistication, because we're moving so quickly with the way that Bitcoin works, as opposed to, some stock certificate that goes through the transfer clearinghouse and everything like that.
Yeah.
So is there a way to adjust the return, even if, like, Coinbase says, okay, he bought Bitcoin today and sold it the next day, but really I sold it to Binance and it's still one Bitcoin. I haven't actually sold the Bitcoin. Is there a way to adjust the tax return to reflect that it's still in kind, or do you have to calculate it as a buy sell?
So if you're doing all that manually, if you're the kind of person that doesn't trade too often, and you're doing that manually, then you just want to make sure you keep your records and show that this was actually a transfer, as a withdrawal or a deposit instead of an actual sale, and then calculate your taxes based on the way you've classified what transactions were sales, what transactions were purchases, and what transactions were transfers. There are some tools that are out there on the internet that you can use to import your information. Some of them have APIs that you can get a key to plug into it so that it'll pull all the data automatically. And a lot of times the exchanges do have, from what I've seen, most of the major exchanges do have classifications for withdrawals and deposits.
Okay, so you can go.
So
you can say.
So when that information comes through, whether you take it off for your personal use or whether you put it into one of these tools that you can use for tracking your transactions, you can at least have it classified as deposit and withdrawal.
What about transfer in kind?
They don't have transfer in kind. It's going to be a deposit or withdrawal. So that's where the next thing I was going to go with is, so you have all your deposits and withdrawals. One thing you need to do is go through manually right now, because like you said, there's no automated way that this happens. Go through it manually and be able to say, okay, with this withdrawal went to another exchange, so I'm going to leave it as a withdrawal. And most of these software tools that you can use, it's not going to make that a taxable event. But now you might have another withdrawal that was actually to somebody's wallet address where you bought a cup of coffee or you purchased some service or good. That you're going to want to make sure you change it from a withdrawal transaction to an actual sale transaction to show that you actually use that for consumption.
Okay, so withdrawal isn't a taxable event, but a sale would be. That's the sale of the Bitcoin. That's where the tax comes. So withdrawal, you still keep your original cost basis anytime you're clicking withdrawal. Okay, that makes sense.
The different types of packages that are out there for doing tracking like this, that's how they all operate.
Okay. And now what about if you move everything to cold storage and then, so at the time that you move it to cold storage, would that be considered, that would also be a withdrawal where you're not going to have to pay tax on it?
Correct.
But then what if you lose your cold storage keys? You just never have to pay tax on that stuff because you're not ever going to actually sell it because now it's lost.
Yes.
Okay.
And as far as, because I know I've had people ask me questions too about I lost my Bitcoins, can I get some sort of tax benefit from that?
Right.
You can, but it's just like any other kind of loss.
You have to prove
like
it.
That. Well, no, it's I can't think of the correct term off the top of my head right now, but if you've lost your coins on an exchange because something the exchange did, then you can claim the loss of the value at the time of the loss.
Okay.
But if I bought Bitcoins for $10 a piece and I held them for years and years and years, and then I lost my private keys and I didn't have access to those coins anymore, that kind of loss has to be taken at your cost basis.
Oh,
so if
that sucks.
Yeah, it's horrible. So if I had 5 Bitcoins I paid $10 a piece for, then I got $50 that I could write off as a loss.
Okay.
Because I mean, and I like to compare things to other situations so people can understand. If you've got your laptop in your car and your car gets broken into and they steal the laptop, if you don't have insurance that covers that, then it's the same sort of thing. You get what you paid. You get whatever you paid for that is the most that you can claim for that kind of loss. You can't say, well, that laptop has appreciated in value.
10 Bitcoins on it. Now it's worth.
Now it's worth so much more. Yeah, it's whatever you paid for that. That's what you take as a loss. So that's unfortunate, but that's where the laws are for right now.
Okay, that it kind of, I guess, when you say it in context of the laptop, it does make sense.
Yeah.
Now, so would it be the same thing? So if the exchange loses the money, you get the value on the day that the hack happened. So that makes sense too, I guess. What about? So I don't think we talked about like-kind exchanges.
No, not yet.
Can you maybe elaborate a little on those? Like, do you think that people, if someone comes to you prior to 2018 and they have a bunch of like what they thought they were doing as like kind exchanges, do you count it as that and then you change after 2018 to do it differently, or do you go back and calculate it as if like kind exchanges didn't apply to crypto?
I give them an option.
Okay.
Because for anybody that doesn't know, as of January 1st, well, just a little primer on like-kind exchange.
Sure.
If anybody doesn't know, like-kind exchange was originally for real estate, where somebody might have a CVS that they own, and there's a Walgreens in another town that they wanted to to buy, sell their CVS, buy that Walgreens. Like Kind came up to be able to say, okay, even both owners could swap that property and keep their original costs, so they don't have to pay all the taxes on the appreciated value of those businesses for however long they owned them. That got applied, that happened, and then it started getting applied to things like gold, commodities, and artwork, and a lot of other types of things. Sometimes it worked, sometimes the IRS said, no, you can't do that. So just a real quick example on gold. If you've got, if the IRS had said, if you've got gold coins that you're swapping for a gold bar, as long as the value of those gold coins is all based on the value of gold, then that's fine. That was a like-kind exchange. But if you had some Spanish doubloons that you purchased from some shipwreck, and so really their value's 30% in the gold and 70% in the value of the historical context that those coins represent, that didn't represent like kind, and they wouldn't let you apply that.
Okay.
So that's why I give people an option. I say, okay, prior to 2017, I haven't seen anything out there that anybody's gotten in trouble with using like kind for cryptocurrency. I don't think it really applies, because the reason a coin forks or a new coin comes up is because they're changing the characteristics. So it's not
the exact same
the
thing.
exact same thing. So I don't think it really applies, but there's really hasn't been any kind of cases that I've seen.
So if they were, if I think people will be glad to hear that you can't, because I've heard other people saying you can't do it prior to 2017. I agree with you.
Yeah, I wouldn't do it, but if somebody wants to do that, I just let them know, if you want to do that, then just understand that if the IRS comes back and says, you know what, this was not allowed, and we don't believe that it really was like kind, then you're opening yourself to the late fees, the penalties, the interest, and everything else for not reporting those taxes.
Okay.
For doing it as like kind.
But not a criminal penalty or anything like that.
And that's going to depend.
Okay.
If you got a couple $1,000s, no. But if it's a large sum, of money, then that's where I would recommend that you avoid the like kind.
Yeah.
Just like with stocks and bonds, the traditional, the route that you go with that is first in, first out. You need to track. That's why it's important to keep track of your costs, what you bought at, and what you're selling the coins at, so that you can say, okay, I've got this Bitcoin that I paid $100 for. I sold it when it was at 8,000. I've got that gain for whatever period of time, and go ahead and pay the taxes for that period. So I let people know. I know it's horrible
so much.
news. It is. It's horrible news to a lot of people. The safest thing to do, you want to be able to sleep at night. You don't have to worry about anybody sending you any notices saying that they didn't like the way that you filed your taxes, whether it's 2017 or 2018 or 2016 or any other time period. Use first in, first out.
Yeah.
Do your short-term, long-term capital gains. Don't even think about like kind.
What about, I think you and I talked about specific identification another time.
Yes.
Is that allowed if you do it all the way through?
It's the kind of thing that you have to be consistent with it. If that's the method that you're going to pick, then make sure you use that method continuously.
And for anyone that doesn't know, maybe you could just say what it is.
So specific identification is where you can identify, again, back in the stock world, you've got the lots that you can specifically identify the lots that you purchased. And so when you go to sell your stocks, you can say, I want lot number 10 or lot number 5 or whichever lot, and you instruct your broker to sell that particular lot of stocks. So you can decide if you want to sell the ones that are higher or lower. The one area that I definitely see I think that's allowable in cryptocurrency. And again, there's no guidance on this, so this is just a professional opinion on it, is if somebody decides to get involved with masternodes. And for anybody that doesn't know, masternodes, where you take a particular number of coins, you lock those, you have to have a transaction ID for that number of coins that you lock in a wallet. So you put them in a wallet, you don't touch those coins again. And that transaction ID is used on your masternode to be able to show proof of stake that you own these coins. And over time, it generates rewards. That masternode generates coins as rewards for having that masternode. You're taking a specific number of coins and you're locking them into a transaction. And that transaction doesn't go anywhere, and those coins don't go anywhere. Because if they do, then your masternode stops generating rewards. I think that's that would be definitely a allowable use of specific identification to be able to say, I've got these coins, I bought them for this price, and even if I buy more coins later on and then sell those coins, I'm going to use the cost and sales price on those newer coins.
Okay.
Because I've already got those older coins locked up. So, but you have to have very good record keeping to be able to identify that.
And what kind of record keeping does the IRS demand? If, like, what if you haven't kept good records and you go back and you try and figure it out and make a spreadsheet? Can they tell if you're doing, like, what if you're off by a day or something? Are they going to know? Like, how did they know what?
I don't think the IRS has the resources to really go back and check all of these things. But if they did, they would, again, the one thing with doing your taxes is you want to make sure that you're consistent with your methods. Pick a method, stick with it, consistent with how you're applying things. So I do have some clients that didn't really have very good records going back. What we do is try to recreate as best we can, and make sure that we do the best we can to figure out what the purchase dates were, how much they purchased things for. If you really, and especially if you're going back in the distant past, back to the example before, like I said, if you bought 5 Bitcoins and you know you paid like $10 a piece for them, but you don't know when you bought them, and you don't know if it was $10 or $20. Well, if you're selling them at $8,000, you just use zero. Who cares?
Yeah.
Just use zero.
So you can always just use zero.
You can always just say my cost basis is zero. I'm just going to pay taxes on the whole game. Again, it's not a very.
But if you're really worried about, it's safe,
it's
and you know you're
bet.
doing it right if you choose zero.
Yes, it's always a safe bet. But if you know you paid significantly more, then you want to try to find out whatever way you can. I mean, if you've got a wallet, it's blockchain, right? So if you've got an address, if you still have that wallet, you have the address, you can go back and you can at a minimum find out when that transaction happened, how many coins, and then as far as what value they had at the time. Again, it's back to being consistent. Pick a major exchange that was in existence at the time, and use that exchange for that transaction and any other transaction that's on that coin going forward, for any kind of transactions where you're not quite sure what the cost was when you had that transaction. So I think if you do that, that's enough. That in the unlikely event that somebody got audited, you have your good records, you have your records, you try to recreate the best you could, and they all follow a good consistent method that you used across the board for everything. I think people would be fine with that. So for anybody that's worried about having to go back a couple of years to try to figure out what happened and not quite sure how to do it, you can. It takes some time, takes some effort, but as long as you're consistent, the one thing that the IRS is definitely going to be upset about is when people try to cherry pick.
Yeah.
Try to find all the highest costs that they can for these prior transactions, and then try to find the lowest sales number that they can for some sale of it to try to minimize every single sale that they have. That you're just asking for big trouble if you do things like that.
And so everything, should you look at it in terms of the Bitcoin price or the US dollar price when you're calculating it?
Taxes is always US dollars.
Okay, so go through every transaction, figure out. So when you're buying it, you need to know how much sometimes if you're buying on an exchange, it's easy to know the price you paid in Bitcoin, but you have to figure out how much you're paying in terms of US dollars, which means knowing the price of Bitcoin that day as well as whatever altcoin you're buying. So any trade, you just want to know that US dollar number so you know if you made or lost money, which makes sense anyway. It's good to know because otherwise, I know when I started trading, I wasn't always keeping the US dollar amount, and I had no idea if I was making or losing money because the price of Bitcoin fluctuates so much.
Exactly, the price of Bitcoin fluctuates as well too. So if you're hodling, right, then it's not that big of a deal because you buy those coins. You know how much they were at the time you bought them. You can always go look up the price and see how much the price is now. But if you do tend to trade coins or swap coins around, if you like to really dig into the altcoins and figure out which ones you think have really, I mean, in my opinion, the ones that have the best actual use case scenarios and actually have characteristics or products or services behind them that seem like they're really going to be of value to somebody. I think you're swapping those things around quite a bit. Again, there are tools out there that can help you with tracking that stuff, and that tracking does help you identify what the US dollar amounts equivalents are for when you're doing those transactions too.
And what about ICO coins? Is it the same thing? Your cost basis is how much you paid into the ICO, and the sale, whenever you sell out of those ICO coins, would be your tax amount? Okay.
Yep.
And what about income, like from mining?
Yes. Like I mentioned with masternodes before too. So whether it's mining or whether it's masternodes, again, this goes back again to the 2014 IRS guidance that came out. That is categorized as income. So if you've done your mining, if you got a miner, and when you get those coins, upon receipt of those coins, whatever the market rate is for those coins, that's considered income to you. So you're going to report that as regular income. It's going to be taxed under your income tax rate, whatever rate that you fall under for the year. If you hold those coins, that's also your cost basis for your either short term for under a year or your long term gain whenever you decide to sell those coins.
So if I got you to do my taxes and I paid you in Bitcoin, you would have to calculate, like, say it costs $500 for, whatever small, it's probably not full taxes, but anyway, say I paid $500, that would be the income that you would add. And then if the price of Bitcoin was today 8,200, that would be your cost basis. So if you sold your $500 worth of Bitcoin later, you'd just pay the gain on that amount.
Yes. Right.
Okay.
So upon acceptance, it's income, and then if you hold it, whatever it goes up to or goes down to is going to be your gain or your loss on that, and it's going to be the same thing with masternodes. So you've got if you need 1,000 coins for a masternode, you've got your cost. If you didn't have them already, you went out and bought those 1,000 coins, then that's your cost basis on those 1,000 coins. You're now locking them up in that masternode. If that masternode generates a coin every couple of days, those coins that get generated are going to be treated as income. And then if you hold them short or long term, then there's going to have longer short term capital gains on that too. So yeah, it definitely gets more complicated when you're doing mining or masternodes with proof of stake.
Yeah, the best thing to do tax wise, just buy and hold, I think. It seems like
it's the simplest. It's the simplest thing. I don't know if it's the best, because if you it depends on where you think things are going. If they're going up or down, as we've definitely seen this last year, and with people that have been in it longer than I have for the previous years, with the ups and downs. So.
And then from a overall adoption standpoint, at the Senate or the congressional hearings last week, there was this guy, Dr. Michel, and he suggested that Bitcoin should not be taxed. Maybe, and he did say there's some distinction between using it as a store of value and using it as an everyday currency, but he was talking about the competitive market being stifled because people can pay in cash without having to worry about all this record keeping and taxes. And, if they want to buy coffee with Bitcoin, there's a lot more that has to go into it than just if you were to pay with cash. Do you think that the current system makes sense, or would it make more sense to have some kind of amount that wouldn't trigger a taxable event, and then some kind of amount that would be taxed as it is right now, like the stock market?
So I think that it would definitely be helpful in adoption for cryptocurrencies for payments if there was some sort of threshold that would, if the purchase was under a certain amount of money, that it wasn't a taxable event. That obviously would be very appreciated, and that would help adoption quite a bit. The challenge I see with that is being able to make sure that somebody can qualify that it was actually a purchase and not a transfer. I mean, because like an in-person transfer where you have $500 worth of Bitcoin and somebody's got $500 worth of Monero, and so you swap your coins and then pretend like it was a transaction.
Okay, like I was buying.
Like you were buying something from somebody.
Okay.
So it sort of strikes me as like the kind of paperwork that you have to keep for expense reports, right? If you're going to have purchases, there probably would need to be some sort of requirement to have receipts to show that purchase actually happened, a receipt that came from the merchant that you bought something from. But I think that would be very helpful.
But then
It's
it would
just,
still stifle it compared to cash, because I don't need
yes,
to keep a receipt for every,
time you buy
$2
a
transaction,
coffee.
or, gas or whatever it is you're buying.
Yeah.
But
So, and the one example I give on that too is that I've given in tax classes that I give it. We haven't mentioned block spaces.
oh yeah.
Working out. I do a lot of work with block spaces here in Tampa.
And they've generously given us their podcast studio as well.
Yes, yeah, to be able to use for here. But that's one thing I've mentioned in the classes I've given there is if I have a dollar, let's say a cup of coffee is say a cup of coffee is a couple of dollars, right? So if I've got my $5 that I stick under my bed at the beginning of the month, and at the end of the month I pull that $5 out and I go buy a cup of coffee, I don't expect to pay any taxes because $5 is $5, right? But if I put that $5 in the bank, and then at the end of the month, which this wouldn't happen, but we're in the crypto space, so I'm going to pretend like it can.
Yeah.
End of the month, I go to the bank, and that $5 is now grown to $10. It's doubled in the month, right? If I pull $5 out to go buy my coffee, I don't expect to be paying any taxes on that $5 that I went to go buy my coffee for. I mean, there's the sales tax on the coffee maybe, but right, I don't. But the bank's going to send me a statement at the end of the year that says I owe income tax on that $5 gain that I had on the money that was sitting in the bank.
But that's nice of the bank to prepare it and calculate it
Yes,
for you. We don't have that luxury right now.
Exactly. They do all that for you. They say, here's the form you guys. So when people are concerned about the fact that they've got to keep track of the coffee they buy or the groceries they buy or paying for a movie or whatever they're paying in cryptocurrency, I try to just frame that in the perspective of the fact that you put $5 in at the beginning of the month, and then you got to go see that $10 movie at the end of the month. There's value in that. And like it or not, as U.S. citizens, our government expects that if there is any kind of gains, any kind of income that we make or any kind of gains on investments that we have, they're expecting taxes for that. So I'm not holding my breath for there to be some changes where you can get these tax-free types of transactions.
Yeah.
I think that might be very difficult to do, but it would be nice if they could come up with some structure that allowed people to be able to do that, because that would definitely help with the adoption.
Well, I think they tried to put that Crypto Tax Fairness Act in I forget what states now were trying to do it, but it never got through. But it looked like a really good plan to me. It was $600 was the cutoff amount that they had. Yep. So anything under that, whether it was trading or just for your coffee or purchases, I think they had a blanket.
It's a blanket for everything.
Anything under 600 is not going to be taxed, but it it didn't get passed.
Yeah.
So
and with those examples, you can sort of understand why.
Yeah.
It's just like with the tax-free purchases on the internet that people have, and there's always been a lot of local and the federal government getting a little concerned about the tax revenues that they're losing. Because of all that, there continues to be pressure on trying to make everything taxable, so that the states can recover their revenues that they're losing through all those transactions.
Yeah.
So.
And at that same congressional hearing where the one guy was saying not to tax it, another person from the CFTC, the Commodities Futures Trading Commission, asked for $281 million to increase their oversight, and the response was, well, why doesn't the IRS start taxing this more aggressively so that we can give you the money from there? So I wonder what we'll see from taxes coming forward.
Unfortunately, I
think this was the year for the ICO regulation, and next year probably we'll see. I don't think they've done a single action, or maybe they have, and I don't know about it. But other than these notices going out to Coinbase holders, I don't think anyone's been penalized for not paying Bitcoin tax yet, but probably going down the road.
Exactly. I haven't seen anything yet, but they can reach back. I mean, they have
How far back can they reach? It 7 years?
7 years.
Ooh, yeah.
Typically they're not, again, with the IRS being sort of under-resourced, underfunded. I think typically they don't really go back much more than 3, but there's no guarantee on that. They can go back the full amount.
And so I wonder, like, anyone that mined thousands of Bitcoin at the beginning, even if it didn't have much value, they can track those wallets using the Chainalysis, and anytime that person put one of their legacy mined Bitcoins onto, say, Coinbase to sell it, then they would see that link and they might be able to say, hey, you're the one that owns all these, we're watching you. But
yeah,
it's funny because it is pseudo anonymous. I know you can't like suggest anything that would avoid paying taxes, so we don't even need to get into any of those topics.
But yeah, that's the one thing that's one of, just like people for well after that notice came out in 2014, a lot of the community thought, okay, that's fine, as long as I don't go to cash, as long as I don't cash out my crypto, then I don't owe any taxes.
Which is true if they keep holding it.
Well, no, I'm talking about if somebody bought Bitcoin and they transferred that to Ether and they transferred it to Monero or Dash or Litecoin or any of the other ones, they're like, okay, well, I didn't cash out the USD, so I don't have to worry about taxes. And unfortunately, that's not true. I mean, it'd be nice if that was something that was available, but it's not really true.
And so, I think the number difference on like someone who's an active trader, like I saw a couple of people who had done the what's the software
with the bots?
Bitcoin.tax. When
Bitcoin.
You pull all the CSV files out of that with over like 3,000 trades, but none going to cash except for $20,000. If they were just to pay on the $20,000, it's not a huge tax bill. But if they had to pay on each of those trades, and at that point it was before Bitcoin.tax has gotten more sophisticated, but back then you could tell it only calculated on so I could see the difference. Like if they were paying tax on all the different trades, it was like $220,000 tax they owed. If they just paid on the 20,000, it was like $5,000 tax they owed. So such a big difference whether that likekind or not. Well, that person was probably an anomaly with that many trades, but I mean, he's probably not alone either.
No, probably not. And for 2017, that's a very possible scenario, because of the values of the coins going up for so much over the whole year. And that's why I say if for people that did file likekind, I mean, it's just it's not the safest way of filing, but especially with the change with January 1st, 2018, they were going to have to pay those taxes in 2018 anyway. So it is a risk. And it's something that I don't recommend. I let people know the risks if they're gonna go that route. But yeah, that's something that's hopefully in the future here we'll be talking about a little bit more too. Because if we see Bitcoin going up to the old high it was before and going well past that, which a lot of people that understand the technology know that seems to be inevitable because of the nature of Bitcoin and any other currency that's really decentralized, and especially if it has a limited number of coins that are out there, limited quantity out there, it's going to be something that keeps coming up. Is you're going to have people that, and that's why I try to help people here at Block Spaces understand that it's not the worst thing in the world if you're paying taxes, because that means you made money.
Yeah, but for some of the traders, it doesn't mean they made money because they didn't cash out. They just have to pay. They could have made a bad trade. They made money on one trade, then made a crappy trade, and now they lost all that money. They still have to pay the tax on.
No. If in 2017 they had a coin that went from $100 to $1,000, and they swapped that for another coin they thought was going to go even higher, faster, and that coin's value dropped back down to $100, as long as it's within the same tax year. That's the thing that really
they can write all their losses off.
You've got your capital gains, you've got your short-term gains and losses that can offset each other, and you've got your long-term gains and losses that can offset each other. So for that if those two trades, they wouldn't have any tax liability. Because they started with 100, they went to 1,000, and then they dropped back down to 100. And if they swap that coin at that point, they sold it.
Then they're starting.
You got a $900 gain, you got a $900 loss. That nets to zero. There's no taxes. Okay. The issues that I've seen with some clients is that they did all this trading in 2017, right?
And then 2018 is when the values all dropped.
And then they either continued trading and didn't do a great job in 2018, or they just decided to hold their coins in 2018, and they didn't get out.
Okay.
And so they saw such a decline in the value of their
That they didn't
accounts
want to sell it.
that now they're looking at this tax bill of $20, $30, $40,000, and they might only have $40,000 worth of cryptocurrency left because of the decline in the value.
Yeah.
And that's where people have had a lot of pain
Mm-hmm.
in filing their taxes. Is it can wipe them out.
Yeah.
Now, hopefully that's the worst case scenario where they get wiped out. There's other people that may have been making gains in 2017 and were cashing out and spending those gains in 2017.
Yeah.
So they make it to 2018 and they really have little to no crypto left,
Mm-hmm.
but they had 100,000 or 150,000 or more in gains for 2017 that they owe taxes on. And so,
and I remember reading one thing that the short-term gains is only $3,000. So that's not, I'm wrong in my thinking there?
No, well, this, again, I'll try to be quick on this. If you have, the 2017 is not a good example because most everybody had gains for 2017, right? But let's say for 2018, somebody's got, when they net out all their gains, they've got long-term gains or long-term losses of $20,000. Okay, they don't have any gains to offset that, so they got a loss of $20,000. They do have their earned income. That's where the $3,000 limitation comes in. They can only, when you're taking from one category to another, so you're taking long-term losses or short-term losses, and you want to apply that to your earned income, because you're changing categories, you've got that $3,000 limit.
Okay, but would the other 17 go towards next year and the next year and the next year?
Yes, whatever. So you use your $3,000 of that $20,000 loss, you got $17,000 for the next year. If you have gains the next year, long-term gains, then as long as it's in the similar category, then you can offset against those gains.
Again, with the whole 17,000 the next year? Okay, that's a lot better than the way I understood it.
But if you don't, then it's going to be, so if you say, you know what, I got burned so bad in crypto, I'm never getting back in it again, then you got $3,000 every year. So it's going to take you 7 years to be able to work off that loss over time. It's another one of those things about our tax system is, I mean, the IRS is very happy to take all the taxes right away, but if you have any kind of deductions and losses, a lot of times they don't want to give that money back, and they're going to limit how quickly you can use it. It's unfortunate. I think that's unfair, but my personal opinion.
And how flexible is the IRS? I know in Canada with our Canada Revenue Agency, if it turns out you owe a lot of money and you can't afford it that year, they'll let you pay it over a number of years. You have to meet a certain you have to call them a bunch of times and you know, negotiate it, but they will let you.
Yes.
Will they let you do that here?
They do.
Okay.
It's a little late now. It's not late now to do that. Excuse me. It's not late now to do that. It's just that if you go through that process before the filing deadline, it's a lot easier, and they have a lot of structures that you can use. If it's low enough amounts, you can actually apply through their website and get approval right away.
Okay.
Even if it's higher, you can still do it, use an automated process to do that. You just have to wait. You still have to make payments as you've agreed to, but it can take a little time for them to approve it. And if you have large amounts, then that's where you definitely have the back and forth working with the IRS agents to try to put that in place. But you're always going to be better off, and it's easier to waive penalties and at least easier to waive penalties if you come forward and try to work with them to try to get all that taken care of. So
in order to be prudent, would you suggest people have like a separate account that maybe they move 20% or 30%, whatever they think their income rate's going to be of their gain every time they get a gain, just move it into a separate account so that at the end of the year you're ready for it? That's one thing you can do. Again, my recommendation, one way I put it is, if the first question I ask is, if somebody is crypto rich and cash poor, then you definitely want to do something like that. If you've got an individual that's crypto rich, but they're also cash rich as well too, then it's a preference for them. Because as long as you have the cash to cover those taxes, you can decide to just let your crypto ride if you want to, because you've already got cash to cover it. Again, 2017, 2018 was a good example about how if you're crypto rich and cash poor, yes, it would have been a lot better if you had cashed out enough to cover your taxes in December sometime.
to make sure that that was covered at those higher prices. And you didn't have to worry about selling your crypto at a much lower price to be able to cover. So that's one way I put it. And so it depends.
Yeah.
If you feel like you can cover those taxes with money that's you made outside of crypto, then you can be a bigger risk taker if you want to, if that's the direction you want to go. But for a lot of people, I found a lot of my clients never had a retail account. They might have their 401k at work. They took some extra money they had, stuck it into crypto, and were very fortunate that they did so in 2017 or earlier. And so for individuals like that, it's much better. That's why I say try to learn about taxes, as terrible as they are, as people think they are. Try to learn about it. Try to figure out what applies to your situation and plan for it. And like you're saying, every trade, I don't know that you necessarily need to do it every trade because not so much this year. But if you could have a year where everything is going up for the first 6 months, and then it comes back down the last 6 months. And if you were taking part of your trades out those first 6 months, you're losing that momentum as you're going.
Yeah.
So I would recommend that you keep track as you're going, keep track of where your gains and losses are looking. And just make sure that come December that you look and see where your position's at. And that's the time that's the time to say, okay, I'm going to take 20% of whatever I think I'm going to owe, and make sure to cash that out. So I've got it safe and sound, and I don't have to worry about a bear market hitting for the first 4 months of the year, and then having to go through all that stress. That's not something that anybody wants to have to go through.
Yeah, I agree.
Yep.
Well, thank you. My goodness, this has been very informative. Where can people find you if they want help with their taxes?
Sure. I've got a website is www.temkofinancial.com. Temko is TEMKO. They can also call my office at 813-906-0330. And my email is peter@temkofinancial.com.
Okay, perfect.
So
I'll put those in the like YouTube, comments box underneath too, so people can find it easily.
And for right now, anybody that's in the Tampa Bay area, if they want to know more about block spaces, with all the different resources they have, they're involved with miners, with traders, with people like me for accountants, attorneys like yourself, developers that are developing blockchain. I know I also have an email address through Blockspaces right now too. So peter@blockspaces.io is another way to reach me if you want to know more about the Blockspaces community that we have here in Tampa.
Excellent. Well, thank you so much, Peter. And any last words of advice for everyone out there?
I think I just stay educated as much as you can. Learn about how to secure your cryptocurrencies. Learn how to track them and make sure you keep track of everything. How to make sure they stay safe. Make sure. I mean, I think it's good to pay your taxes. And don't pay any more than you have to, because that's the other thing that I've mentioned to everybody too. Is if you know, the more you know up front, the more you can plan. So you can make sure that you are doing things that make the best tax sense too. So you can avoid paying any more than you have to. Don't pay any more than you have to.
I agree. And don't sell unless you have to, because no taxable event until
you don't have to worry about any kind of trading and selling. If you don't do that, then you don't have to worry about the taxes.
Yeah. Okay. Well, thank you so much.
All right, thank you very much for having me.